Hello. Today we're going to learn some investment lessons from the life of Warren Buffett. As you may know, Warren Buffett is one of the greatest investors of all time. He recently has announced his retirement from the fund that he has been running for a long time, Berkshire Hathaway. And it's a moment to reflect his career and what are the things that he has done right in his investment journey, something that we young people can learn from him. It's difficult to find a good investment guru nowadays in the times of social media where everybody is giving investment advice. But to my mind, Warren Buffett is by far the best investment guru out there. He has seen it all. He has seen many crises in his lifetime during his investment career, over which spans almost 80 years. He has seen it all. So it's good to take advice from someone as great as Warren Buffett. All right, so let's dive into some of the things that he has used in his career, something that we young people can learn from him. One thing he always emphasizes on is that keep investment simple. Don't make it complex. Don't try to outsmart the market. The market will go up over time, whether you invest in index fund or in some hedge fund or in mutual fund, whatever type of fund you invest in, over time there will be growth in your portfolio. So you don't have to think too much and you don't have to make things too complex. Keep it simple. And he insists on let's say investing in index funds for beginners, but even for professionals who do not have time to manage their portfolio, to do rebalancing and all kinds of activities that are needed in actively managed portfolio. He always recommends people to buy index fund and just forget, just buy S&P 500 and just forget. And over time that is going to grow. There will be fluctuation in shorter duration, but over time, if you think long term, S&P 500 would always go up, right? If you take 5 or 10 years period investment horizon, right? And he insists on just buying and holding, and not to just buying and selling or trying to buy at a cheaper price and holding until there is a top and then selling at the top. That's impossible to do. He has said it many times that it's impossible to time the market. Having said that, there are people who have managed to make money by timing in the market, especially the traders. But not for everyone, especially for retail people, right? Retail traders or retail investors, timing is almost impossible. So the best thing to do, therefore, is to buy an index fund or invest in a mutual fund, or just buy good companies. If you have some knowledge about how to assess a good company, how to read a balance sheet, how to know which companies are good and they will be doing good in the future, just buy those companies. But if you do not have the time, it's best to just buy and hold index funds. Right. So avoiding short-term temptation is extremely important, according to him. What people do is that they simply buy shares. The shares go up in 5 days, 10 days, or month, 2 months time. They sell, and then they put that money in buying some other shares. They keep on doing that, but for an average trader, it's impossible to beat the index. So better to avoid that and don't try to be smart. In fact, what he says is that if you have certain IQ, let's say you have an IQ of 130, just give 30 to someone else because you don't need that. So you do not need to be very smart in order to be a good investor. Keep things simple, just buy and hold. That's his view. One other thing he insists on is that if you're trying to be an outsmart guy, you're trying to outsmart the market, right? You are trying to take risky positions and so on, you could lose a lot of money, and that is the worst way of investing. And we'll come to that in a moment. And that's what it is, right? Margin of safety. That means What's very important is to save your capital, protect your capital. Oftentimes we talk about how to grow our capital, how to get good returns, how to outsmart the market, how to beat the market. If S&P 500 gives 10% on average, how do we get 12% or 15%? How do we select, a set of stocks from the S&P 500, let's say 20 stocks that would give a return higher than the average return of S&P 500, right? So that's almost always talked about. But what is not talked about is that how to ensure that your capital is protected. Imagine you have put all your money in Nvidia, which is a great stock, the most valued stock at the moment. But imagine there is a crash in the market. AI hype just doesn't work anymore. You will be losing good part of your portfolio in that. So very important not to lose lot of money, and the only way you will lose lot of money is by taking concentrated bets. If you are putting everything, you're going all in just one or few stocks, there are chances that you could lose quite a bit of money. So capital protection is extremely, extremely important in any investment strategy. For institutional investors, it's very clear. Risk managers actually tell them that it's very important to protect the capital. If you're working at a pension fund and you are an investment manager, you will be given instruction by the board, by the senior management, by the risk managers that you cannot take concentrated bets. Even though you are convinced, you have the conviction, you still cannot do that. You're not even allowed to do that. But you can do that with your own money, because with your own money, you are the head of the investment committee. Nobody is going to challenge you on that. So you may put all your money in some meme stocks. That could well be the case. And what will happen is that you will lose all your money, right? Or you could put all your money in Bitcoin or some other cryptocurrency, and then there is a 40% correction, and you will lose substantial part of your wealth in no time, right? So very important thing therefore is to remember that protecting your capital is very important, right? What it says is that there are two rules in investing. First rule is do not lose money, and the second rule is do not forget the first rule. So what is essentially saying is that don't try to take risky bets. Don't try to be a smart guy that you know everything and so on. There are some basic principles of investment, diversification, spreading across asset classes, ensuring that you have good asset allocation, uh, especially for a retail trader. These are things super important for you to know and follow. So protecting against downside risk is super important, and it is less talked about. No, none of the finfluencer, financial influencer will talk about that, because they only talk about where you can grow your money. They will never talk about how to protect your money, but that's super important, especially for the young guys, right? The Gen Z investor, that's very important. Many of them haven't seen a downturn, especially the ones who have started investing post COVID. They haven't seen a downturn, a proper downturn yet, but they will eventually see one day. And unless you are prepared for it, you probably will be losing a lot of money, right? One other thing he insists on is that invest in what you understand. You know, we have this FOMO concept, right? Feeling of missing out. Extremely important concept to understand in the field of investing. What people do is that they suffer from FOMO. They invest in stocks or in assets which are very popular and very, there's a lot of crowd out there. For example, buying Nvidia stock or buying Bitcoin. Everybody is buying Bitcoin. If you don't understand what Bitcoin is, what its actual value is, or you don't understand what is going to be the case for Nvidia, and you go all in, that's going to be an issue, right? So it's very important to stay course in what you understand. If you understand consumer market very well, if you understand banking very well, just put your money in those sectors instead of trying to just follow the crowd, right? So again, this is for people who are investing in direct stocks and not index fund, because if you're investing in index fund, you don't have to worry about this because it's a diversified fund. So you don't have to worry about which companies do well and which companies don't, because that's already taken care of in the index itself. But if you are someone who's picking stocks, selecting stocks, buying and selling at the right time, you have to be extremely careful about uh, sectors that you understand very well. This is also important for fund managers. If you're working at as a fund manager at a mutual fund, at a hedge fund, at a pension fund, sovereign wealth fund, then it's very important that you specialize in some sectors and gain a lot of knowledge, and then based on that you make decisions instead of trying to just follow the crowd or follow the trend, right? What he says is that stay within the circle of competence. So whatever area you understand, just put money there. In fact, what he missed out on was in 90s he couldn't invest in tech stock. He'd never understand the internet very well, so he'd never put money in internet stocks. So in a way, he actually lost a lot of money because he did not put money in internet stocks, and some of these stocks did very well. But he managed to avoid losses during the dot-com crisis in 2000. So in a way that he managed to protect his wealth. Obviously, the growth rate was less compared to, let's say, if you had put some money in Amazon and PayPal and so on. But that didn't bother him because he really made good money even in other sectors as Coca-Cola, Bank of America, and so on. The other thing was what he says that be greedy when others are fearful, and the other way around. Be fearful when others are greedy, right? At the time that we are living in, people are so greedy because the market is doing so well. It's been a bull market for many years, so people are greedy. They're putting all their wealth in the stock market and not keeping money for themselves for emergency, not putting money in debt funds or not. They're not buying treasuries, safe assets and so on. So that's a terrible way of investing, because if there is a market crash, you will probably be losing money, or you will be losing the opportunity to buy at a cheaper price, right? So very important, therefore, that when people are really greedy, you should not invest a lot of money at that time. You should be a bit more conservative at that time, right? So buy less when there is a bubble, or don't buy at all. If you can just put money on the side and wait for the right time to buy, that's also a good thing. But not everybody can do that. So make sure that you buy when there is a stock crash. For example, during COVID, right, there was a downturn for a few months, and that was a right moment to buy more and more, right? But very important, therefore, is to have a diversified set of portfolio. That means you have also money in debt and cash. Only then you can buy more at the time of a stock crash. Otherwise, you will not have money to buy, so you lose the opportunity to buy at a cheaper price. And that's why Warren Buffett is high on cash at the moment, because he sees a correction, a strong correction, maybe in the few years' time. He's very patient. He has been holding cash, I think, in the order of hundreds of billion, I think over 300 billion for the last 3 years already. He's just waiting for an opportunity where he can deploy the cash. And it hasn't yet come. Probably it's going to come sooner or later, maybe in a year time, 2 years time, 3 years time. But he is not buying just because everyone else is buying. Okay, one other thing he says, and perhaps all of us know about this, compounding is great. It's perhaps the eighth wonder. What I personally have realized is that you don't realize the power of compounding just by understanding the concept. You realize the power of compounding only when you see that on your portfolio or in your portfolio. That means unless you get the real life experience of that, you will never realize how powerful it is. I mean, when you read about it, it sounds amazing, but when you realize it in your own life, when you see your portfolio growing, compounding, that is even a better experience, a greater experience, right? That means it's such a powerful thing, right? And the unfortunate thing is that the young people simply cannot realize because they don't have a lot of money to invest, so they don't see the compounding effect early in their life. But if you ask your parents, and if they have been investing for a long time, they would tell you how crucial it is to invest early to put money early, to save money early. That's extremely important. Now, I'm 38. Now I have, I have starting to realize how important this is. I wish I had known this 10 years back or 15 years back, right? So for young people, extremely important that instead of just trying to pick the best stock, instead of trying to research a lot on cryptocurrencies, just buy S&P 500 index fund or any other index fund that you're comfortable with, and just hold it. Over time, this is going to grow. You need a bit of a patience. Maybe for a year or two, it won't grow much, but over time, this is going to grow and grow. Just focus on your career. Whatever money you save, just put that in some index fund and let that grow over time. After 10 years, you'll see your portfolio, it would have grown leap and bounds. So, what Buffett says that his wealth is a combination of three things: compounding, time, and discipline. Okay, he is not the best stock picker. He is not projecting that. But what he's saying is that he has benefited a lot by just being in the market for a long time. And that's anybody can do, right? You don't have to be a smart stock picker for that. If you just buy the index, even that gives you a good level of return in long run. Discipline is very important. That means if you are just doing trading, buying, selling every day, you're doing option trading, I think that's not the best way to invest your money. Time, you have to be in the market for a long time. So you'll see the compounding effect only in your late 30s and 40 if you start investing at the age of 25. Right. So early investment is very crucial to realize compounding late in your career, late in your life. All right. So these are some of the things that are worth learning from Warren Buffett. To me, he is the greatest investor of all time, and his advice is super important. Even though you may not believe, you may not like some of the advice he gives, because he's old school, right? He belongs to the old school. Sometimes his advice is somewhat primitive. Some people think so. I don't think so, but that is not the case. I have personally realized he's one of the few investors to follow if you really want to learn investment lessons. No matter whether retail trader, you are a professional trader, if you are a professional investor, fund manager, whoever you may be, Warren Buffett will remain as one of uh, the best investment guru uh, for all of these people, right? All right, thanks guys. See you in another video.